When I first started investing in real estate, I didn't have enough cash to buy multiple properties. And neither did my guest for today's interview, who started 4 years ago and now owns dozens of properties. How do we buy properties without our own money? In short, private money lenders. We used other people's money. And in this conversation, we're going to explain how you can do it too. Let's get started. Welcome to the podcast, Real Estate Investing with Coach Carson. I'm your host, Chad Carson. You can also call me Coach Carson, and this is a show to help you get out of the financial grind so you can spend your time doing more of what matters. My guest today is Soli Cayetano. She started investing in real estate 4 years ago, and today she owns 49 rental units. She was able to quit her job, and she does this full time. I'm super impressed with Soli. She's humble, and she's very transparent, both on her Instagram channel and in this interview. Now let's get to the conversation. One of the first distinctions I was hoping you could explain, because you've done a lot of different sources of money, is the difference between private money and hard money, and then using a partner, like a private money partner. Maybe you could just kind of give the high level explanation of that, and then we can dig into your story as well.
So when I bought my first rental property, I used all my own money, but it was like $50,000. And then after the first one, just like you said, I was like, wow, how am I supposed to buy the next one? Because it literally took me like 3 years to save up for that first rental property. And at that rate, it would take me decades to reach financial freedom. And I was like, there had to be a better way to do this thing. And so I was sharing on social media, just like sharing, my whole journey, the ups, the downs, everything in between. And someone reached out to me saying like, I'd love to invest in your next deal. And that's when I discovered, the concept of private lending. I just didn't know what I didn't know until someone asked me to invest in my deal. So I started reading, the books, Raising Private Capital from Matt Faircloth, and understanding what it meant to have a private investor. And so to answer your question, like the difference between hard money and private money, hard money usually comes from a financial institution who is in the business of lending money, and private money comes from an individual. It could be literally you, Chad, or someone who, like your neighbor, someone who's a friend, a coworker, your parent, a family member, just someone who is lending their own money and isn't formally in the business of lending money. That's like the main difference between private money and hard money. And partners are typically, they come in for equity. So they have ownership in your properties.
I really like that overview of the differences between those, because I think some people get those confused. So if someone was like, all right, I like the idea of using other people's money, I either can't get another loan or I run out of down payment, do you recommend that someone who's brand new try this strategy? Or is this something that maybe somebody's a little bit more advanced?
Yeah, I always recommend that you have all the learning and make all your mistakes with your own money. And while you're doing that, you're also building your credibility. You're building your proof of concept. You're testing your team. You're making sure that you're investing in the right market. And then you have that, credibility package to go to investors and say, look at what I've done. I've learned with my own money, and now I'm looking to take on investors. So I recommend that it's a little bit more experienced people who end up using private money.
Yeah, got it. So like in your case, you saved up the cash, you had the $50,000, which is pretty awesome, by the way. You did that during college. I think that's pretty amazing. For other people, it might be, hey, I did a house hack or two, or I worked for somebody else and I helped them flip a house. So it sounds like the point is just like, if you're going to go ask for someone else's money, having some kind of credibility package, before and after pictures, just like something to go off of is probably the first step. That way you're testing it out. And then like in your example, the first deal, you bought a rental property, you live in California, you bought it in Cincinnati. The second deal, you mentioned someone, just a family member, I guess, right? Just saw you on Instagram that you were sharing everything, which I think is really cool. And they were just like, hey, I didn't know you did that. Or, hey, I wonder if I could participate in this. What was that first step like? Because some people, I think, have a mental block against even asking people for money, especially maybe even family members. From the time that person just reached out to you, from the time you did a deal with them, like what was that conversation like? And how did you approach that, not having done a deal like that before?
I definitely have a mental block on asking people for money. And like, I definitely would never ask my family for money. It's just like the type of person I am. I got a job at 14, so I didn't have to like ask my parents for money. But I thought it was really interesting because it was my mom actually, but she reached out to me and said, hey, I have some money to invest. I would love to support you. Have been watching you on Instagram, have been listening to your podcast, super cool, want to support you. It was interesting to me because you never know who has money that they'd like to put to work unless you ask. I didn't have to ask in this scenario. She asked me, but that kind of taught me to keep on asking people, even if I thought that they didn't know. In terms of the conversation, I didn't know what private lending was. I didn't know what it was called, but I knew that there was good educational resources I could read about. So I read Matt Faircloth's Raising Private Capital book, which kind of explained the difference between debt and equity equity, what it means to be an equity partner versus a debt partner. And from there, I like sat my mom down for a formal presentation where I kind of showed her everything. I think she thought it was funny because she's like, you're my daughter. But like, I wanted to show her that I took it seriously and wanted to walk her through, the documents that I learned about in the book and how they would actually work to protect her investment and what the investment would look like and what my exit strategy was. I think that kind of helped her and kind of set me up for success when talking to other investors who weren't my friends and family.
Yeah, I love the formal conversation. I had a very similar experience, and I started in my early 20s. I wasn't doing social media, which I think is so smart. I hope people like replicate and learn from what you're doing with that. But I was just sitting around the Thanksgiving table, and I decided not to go to medical school. And my grandmother was kind of worried about this. She's like, "Oh, what is he doing? Like, what is he out flipping houses? Is he even going to make any money?" And she asked me a question just in passing, like, well, how are you doing this? You don't have any money to buy these properties. I was like, yeah, I borrowed money from someone at 10% interest. I paid them back. We sold another house. And she was like, 10% interest? Like, you're going to go broke, Chad, paying somebody 10% interest. And I said, well, actually, no. So I started explaining it to her. And by the end of the conversation, she came to me later, was like, all right, I've got this money that I inherited from my brother. Like, nobody else in the family knew about this. And she's like, it's sitting in some account. It's making me nervous. And I don't really want to put it in the stock market. I'm not going to charge you 10%. Could you pay me 7%? It was like something like that. And
sure thing,
so,
Grandma.
Sure thing. Yeah. She negotiated me down, right away. So we're going to talk about how do you get private money from other people who aren't in your family, because a lot of people don't have someone like a grandma like that to do that. But I guess the point I want to share with people with your story and my story is that if you don't tell people about what you're doing, you'd have zero opportunity to get a situation like this. Like, because most of us hold our cards closed. We don't tell our story. I know I had a hard time like sharing that. So do you have any advice for just in general, you're starting with no private money and you want to start telling people either social media, around the Thanksgiving table, whatever, like, do you have any advice for how you talk about it in a way that's not awkward and weird to get over that hump?
Every conversation is an opportunity to steer conversations. And so if someone's asking you, what are you up to lately? You could either choose to talk about the new video game you're playing, or you could use it to talk about real estate investing. I think everybody, even, in situations where you're at a meetup and you say like, what do you do? I know I have a bunch of students and they're like, they're so hesitant to switch from identifying as like a W-2 worker into I'm a real estate investor. And even saying I'm a real estate investor and I use other people's money to fund my projects, like that just opens up the conversation. Maybe it doesn't. Maybe, they're not really interested in that topic and the conversation goes a different direction, but it gives the opportunity for the person on the other end, like your grandma, to say like, what do you mean? How does that work? I can earn double-digit returns that are fixed, that aren't variable. And so I think that it's like the education part of it is really important. You're never really, pitching or asking. It doesn't feel like you're having to like do a sales job here. It's really more in the education of it. And then people naturally say, oh, like I kind of want to be a part of that. I have money sitting inside my bank account doing nothing.
That's such good advice. I think sometimes it's like the psychology or the frame that you think about yourself in. If you think about yourself as a salesperson, where I've got to get your money and I got to sell you on giving me money, that's one state of mind. Whereas you say, I'm a teacher, like I'm just trying to teach people and have a heart for helping other people. And I just share about what I'm doing, like, which is totally what your social media channel is. I've always admired that you're just helping people and you're trying to share and you're being transparent. And so if you just do that consistently, is what I'm hearing from you, then naturally some people like it, some people don't, but the people who like it will then reach out to you, DM you, whatever. And then you can follow up with a conversation. You can buy the book for them. You could have a formal presentation like you did, but it starts off with just these informal sharing of what you're up to instead of talking about the weather.
And then the same way happened, a lot of people say, I don't have rich friends and family. I don't want to talk to my friends and family. All my friends and family already said no. They turned me down, whatever, whatever. And that's also where like things like social media come into play. Instead of having to go to people and start conversations, people are actually coming to me to invest with me. They've kind of seen my brand grow on social media. I've been very transparent about the good things, but also the bad things and all the struggles and my life and this and that. And through that, like there's people who have followed me for 4 years at this point who, when I reach out or they reach out to me and say, hey, I've been following for 4 years. Like, I know you're serious about this thing. I want to be involved in your next project. It even then feels like less of a pitch because now they're kind of coming to me and saying that they want to invest with me.
Yeah, totally different psychology as opposed to going knocking on people's doors and selling. You're telling stories, you're teaching, and then they reach out to you, which is totally different from that standpoint. So I want to get into like some of the details and mechanics of how that works so people can figure out how to apply it themselves. But I do want to circle back to your story because I think it's so educational. Like the first deal you did on your own with your own money, getting a conventional loan, making a down payment, it was across the country. You learned a ton. The second deal, you used a private lender, kind of a friend and family kind of private lender. You learned the ropes there. How did you go from there? Because you had, I think, from my understanding, your story is you branched out and started finding other private lenders. Did you do the same model where you just have somebody loan you the full amount of the purchase? Did you find a partner? Like, how did you grow from that second deal that you did?
I didn't go full-fledged into private lending after that. I actually went into hard money lending. So in my mind, I really had not mastered the private money yet. I was still very new, to be honest, in investing. And I didn't think to really ask my Instagram audience who wanted to invest with me. And so I went the route of hard money lending. And I also found a partner because, again, I still had no money at that point, but I did find a partner who could bring some capital and could qualify for the hard money loan at that point. Hard money lending typically is very leveraged, but there still is some component of having to put down maybe 10% or 15% if you're a little bit newer. And so I needed someone to come in and fund that portion because I just didn't have any more money after that. I flipped that house. The next house I bought with hard money and I flipped that one as well. And then that's kind of when people started to reach out to me very organically, going like, whoa, you bought 7 deals in 7 months. Like, that's super awesome. Like, how can we get involved? And I ended up scaling to 25 units in a year by just using the private money that came to me organically through Instagram.
I want to go back to those early deals. So even you were using private money, and I'm assuming that the model there was you were buying distressed properties or fixer-upper properties, something that needed a little bit of work, and you're able to buy it below the full value. Is that right?
Yeah, that was a very odd deal. It's the weirdest private money lending terms I've had because I've now have that money for 5 years, I would say, because it's a friend and family member. In a more traditional private lending situation, it's usually for a BRRRR or it's for a flip, and it's a very short-term thing. It's like, hey, I'm going to hold your money for 12 months, and in that 12 months, I'm going to buy a distressed property. I'm going to fix it, and then I'm either going to refinance it or I'm going to flip it and pay you back your investment. So that's how we do it these days. We've done a bunch of flips last year, this year. I've done a bunch of BRRRR properties as well. And that's kind of our standard sort of term structure.
So your kind of standard deal is buying a property, a single family house, a multi-unit that you can add value to. You buy it below its full value. And that helps you because then you can borrow money from the private lender and still protect their money. They could be at a lower percentage of the value of the property. Another question I had was when you started talking to people who were not in your family, not hard money lenders, and just talking to them about private money, I know one of the obstacles maybe people have in their head is how do you get people to trust you to do that? They're reaching out to you, so I'm assuming there's a little bit more trust there. Was there ever in your mind wow, is this an imposter syndrome or should I really be borrowing other people's money? I'm just wondering about the psychology of not only for you, but also for the other person. How do you build that connection with them so that they trust to hand over $100,000 or $150,000 for you to do your deals?
For me, I guess it's a more special situation because they've been following me for a long time. And so when they're reaching out, to be honest, the type of person who is a private lender is not a sophisticated lender who's done lots and lots and lots of deals. They're typically like a teacher who might have sold their house, who now has $200,000, who now has no idea how to invest and doesn't have any interest in investing in the stock market. And so it's a very different conversation that you have. I mean, first and foremost, people want to do business with people they like. And so, be a good person, be likable, and have good morals and ethics and talk about that. I think one of the things I like to do is lead with education. And so we'll kind of walk through our deal analysis and all of the ways that we've mitigated risk. A very common question is what is the worst case scenario and what is kind of protecting my money? And so we talk about all of the buffers that we have built into our construction budgets, our timelines. We've taken the very conservative approach to our ARVs so that if we don't sell it for as much or the appraisal doesn't come in as high, then we already have a 10 to 20% buffer in there that we've already accounted for. We have our own reserves that we can pay you back with. And by the way, here's my bank statements if you want to see them. And then these are the actual documents that protect your money and how. It seems like a lot. It's really not super complicated, but it's being able to explain the process to people and also answer the questions of what is the risk and what is the worst case scenario? And really, how have you protected me against that?
It sounds like part of it is them trusting you as a person and just liking you and having a likable person. The other part is showing you're competent as a professional. And here's all the paperwork and here's the LTV and here's the documents. And so it's two different sides of competency that you have to be credible from just being an ethical person and who's going to treat people right. And then you got to be a competent entrepreneur who actually can follow through and has reserves.
Yeah.
And so you're demonstrating all that to them through kind of your presentation and also your track record of having done it with other people.
People underestimate how important it is though to like be an ethical person, and everyone's really happy when things are good, but where you really show your character is when things don't go as expected. And kind of talking about those situations, I like to tell private lenders like my reputation is more important than anything. And if I don't like, I will sell everything to pay you back because I need to make you whole. Like I want my reputation to stay good. I think that makes them also feel more comfortable because they also could just blast all over the internet, and I wouldn't want that to happen. And so there's kind of another layer of protection there that like I have integrity, I have great references from past private lenders, and I care about my reputation and want that to be tarnished by a bad relationship.
100%. Yeah, I agree. And the other thing, I like how you talk about the collateral as well. I know in my experience, the people who've loaned private money to me, and it's been a big part of my growth as well, was people who like the sticks and the bricks and they understand real estate. It's like I often had people who already had a rental property, but now they kind of have lazy money and they don't really want to be doing it themselves, but they like working and loaning it to me. They compare a private loan for 150,000 or 200,000 to me that they make 6% or 8%, and they compare that to maybe a syndication or the stock market or something else, which probably promise higher returns, right? Maybe they get a 12% or a 15% or whatever. But I always told them, like, if I got run over by a bus, like I'd have this conversation with them. I'd say, I hope you come to my funeral. I hope we've had a good relationship and you shed a tear or two. But when you leave the funeral, you have this property and you could take this property back. And there's like a tangible thing with sticks and bricks that you can own, you can sell, you can rent, you can refinance it, you can do what you got to do. That makes a big difference. The simplicity of a private lender in the private loan relationship that you've explained is like, that's a big deal, because that downside, that security is really what people with money, that's how you make your decision. It's not all about the upside and making the most money. It's about like not losing money so that you can sleep at night and know that it's still there.
I think it's really interesting because some lenders will choose like either a mortgage or a deed of trust, depending on what state you're in, that really attaches their private lending note to collateral the actual property. But there's other people who will also choose personal guarantees over mortgages. I've had a lot of people tell me that, just like, give me the personal guarantee, I don't want a mortgage, because they don't want to have to foreclose if you got ran over by a bus. They just want to then be able to like have part of your assets. And so I think that's in terms of like security, there's a lot of ways to securitize private lending notes. And typically it's either, a personal guarantee or a mortgage or a deed of trust. Or, I mean, you could also even cross collateralize onto other properties, although that kind of complicates it a little bit.
Let's go there if you don't mind, because we've talked about a couple terms. Like, I just want to go to like the 101 level. If somebody's never, maybe they've borrowed money from a bank and the attorney or the title company did everything for them, but there's some vocabulary that you have to know for you to be competent and to get people to trust you. And you've mentioned a couple, like talk about just the different documents that just make up a private lending relationship. Like what are the basics? And then maybe we'll dig into some of the terms within those documents.
Yeah. So a promissory note basically just tells you like all of the terms of the agreement that you agree to. That's like a universal document that I would say should be signed in pretty much every private lending transaction. And then there's the security portion of things, which is typically the mortgage / deed of trust. It's essentially the same document, but half of the states in the US are mortgage-based states and half of them are deed of trust states. The only difference is how things are handled in case of like foreclosure. Either you foreclose, or in a deed of trust state, you just get the deed. And so then that's getting like a hard collateral. And then the other option is a personal guarantee. There has been some situations where I've signed all three. So a promissory note, a personal guarantee, and giving a mortgage to somebody. But all of these things are negotiable within your transaction and what you want to offer as your standard terms.
Yeah. For example, just to kind of double down on that, for me personally, as I grew, like reducing my own risk as a borrower was always something I wanted to think about. And so for me, I often got lower loan to value loans. So I've sometimes 60%, 50%, 65% if I could, but I would negotiate to not have a personal guarantee so that the lender would know, hey, this property itself is the collateral and I'm not going to walk away from it. I'm going to make you whole. But like in a worst case scenario, like this is this is the deal. So it's all negotiable. That's one of the things I love about private money is that you can, depending on what your situation is, everybody's a little bit different. You can grow and evolve and have a conversation across the coffee table with someone and just discuss what's important to everybody.
I mean, on the way other end of the spectrum, because I feel like that's a very low loan to value, I'm leveraged on the complete opposite way, where I, finance 100% of the purchase price and 100% of the renovation amount. And so when I'm closing deals, I'm literally coming to the table with $0. And, that can be perceived as more risk. Usually we're at like more of a 10% interest rate. Sounds like you're a little bit lower, a little bit less risk in your scenario. And so you're always balancing like, what is the risk? What is the return? And for a lot of my lenders, they're okay accepting, a lot of leverage in, maybe they get a mortgage for the purchase price. Maybe they get a personal guarantee for the renovation funds. And also they're getting compensated at a 10% interest rate instead of a 7% interest rate for that additional risk.
Yeah. And also knowing where you are in your journey. Like early on, I did the exact same thing. And I was borrowing 100% of the money. I was buying deals at 70% of the full value. And so I could borrow 100% of the money because I didn't have the money either, and then flip it or refinance it or whatever. So yeah, it's such a flexible tool. That's what's cool about it. And as you grow up, as you change and evolve your business, those relationships can stay, but then the way you work with them can evolve based on what you need in your business.
I think that's also what makes it scary for people though, is like when it's everything is flexible, what's the thing that you offer? Like what are the standard terms that you ask for? And that's going to where people freak out. I can give you my standard terms. So like what we do for a typical flip or BRRRR deal is typically 12 months, even though we can probably finish it in 6 months. We're always giving ourselves an additional 6 months of buffer. We do no prepayment penalty. So if we end up selling it in 6 months and we pay them back, there's no harm, no foul. That's okay. Occasionally, if it's a bigger project or it's a little bit just, bigger construction, we'll do an optional extension for 1 point. So we'll do like 6 months, but we'll pay 1% of the loan amount as a fee, kind of a win-win situation. We're typically funding 100% of our purchase price, 100% of our renovation costs, and our closing costs as well. So we're really coming down with like $0. And typically we're at like 10%. We used to pay monthly, but we found it kind of hard to manage cash flow because you're making like so many, when you have 10 notes and you're having to pay 10 private lenders $2,000 a month, it gets like really expensive really fast to manage cash flow. I know some people have said like over raise and basically pay them, but I like to defer the payments until the end of the project. It is a shorter term, so it's 9 months or 12 months that they're waiting, but that way when we realize the profit of the flip or we realize those refinance funds, they can just get paid back in full and we don't have to worry about like wiring money, making payments, and title and escrow handles the whole thing.
So the interest rate, 10%, the loan to value, you might have mentioned this earlier, but do you have a typical loan to value? So if the property is worth $250,000, is the after repair value after you fix it up, or pick whatever number you want? Like, is there a typical max percentage that you would borrow from a private lender?
Not exactly. It's really deal dependent. Like there will be some deals where it won't be a perfect BRRRR, but we go in knowing that it's not going to be a perfect BRRRR, and we show our investors, hey, we plan to have $50,000 left in the deal, and here are our bank funds that show that we have 5 times as much cash to pay for it, and it's going to be okay. So in those situations, we still funded 100% of the deal in order to do the transaction. For flips, it's a little bit different because you're not borrowing it, you're flipping it, and so we just analyze the deal and make sure there's at least 20, 30 grand of profit above paying the private lender to be able to pay them back.
That's great. So right now, with what I'm hearing, to your point, like this is so flexible that sometimes you have to get little cookie cutters, say, all right, the private loan, that's kind of a standard way, which I've done exactly what you've done, is you have a private lender for a year to help you flip the property or to help you like flip into another loan. So do the BRRRR strategy where you refinance it. And so in your case, like what's a typical long-term loan that you're using to pay off the private lender in 6 to 12 months?
Typically, it's like either a DSCR loan or like I really like portfolio loans. So portfolio loans being like small banks that don't sell their loans off to Fannie and Freddie. They just keep it in-house. And so you can have like very flexible terms. You can have as many, a lot of people ask me like, what do you do after 10 loans? It's like some people are so like freaked out about what happens after they use up all of their conventional loans. But small local banks who don't actually sell off their loans have very competitive rates as well. And you can get like as many as you want as long as the bank lets you have have
Yeah, I've
them.
used a lot of local bank loans as well. It seems like those have a variety of terms as well. I'm just curious for you, like what have been some of the typical terms on those refinance loans with a portfolio lender for you in your case?
We still can find like 30-year fixed mortgages. Right now, interest rates are kind of high. So they're at like, I don't know, 7.5%, changing by the day. And so we're doing our best. Like there's no crystal ball on predicting where interest rates are going to be, but we try to stick very, very conservative when, especially when we're borrowing, because who knows what interest rates are going to be. You need to make sure that the deal still works, even if interest rates go up a little bit.
Yeah, a lot of people, a lot of big syndications got caught because they underwrote the deal at 5% interest and then the interest rates went up to 8 and then they're having to like refinance and put a bunch of money in that they didn't have, right?
Yeah, so it's usually 30-year fixed. Sometimes it's 25 years, occasionally, and then like a 75% loan to value is more typical what we've seen. So that's kind of how we underwrite our BRRRRs
That's
at the
pretty
end of the
good. Yeah.
day.
So they'll fix it for 30 years. They don't do like a balloon at 5 years or 7 years or 10 years or something. They'll just fix it all the way.
Yeah, at least the lender that we're working with, even like DSCR loans, there's options for 30 years fixed or 25-year fixed. I always like to go, I know there's a big argument about like, do you get the
Yeah.
15-year or do you get the 30-year? I'm always a proponent of getting the longer term because you can always make double payments if you want to, but you can't choose to like cut your payment in half if you chose a 15-year loan.
Yeah, I agree. Yeah, I think the intention behind the 15 year is great. Like I like paying off debt. I've talked about that when you eventually get to a point where you've got enough wealth and you want to take some chips off the table, pay debt off. But getting a 15-year loan puts you in a bind because you have to make that payment. You have no choice. Whereas if you do a 30-year loan, like you're talking about, or at least a 30-year amortization, and even if it has like a 10-year balloon or something, you can make double payments. You can make extra. You can do a debt snowball. You can sell one property and pay off the other debt. So, but it just gives you a ton of flexibility. Whereas if you have like 15-year loans, I mean, you lose most of your cash flow. The bank's making all the money and you have zero. You really have an option to like move some chips around. The other thing I want to ask about is you've mentioned a lot of like the finding the lenders, talking to people, building trust. Have you found that private lenders tend to be like repeat customers? So like if you did a deal with them 2 years ago, are you having to like always find new lenders, or you find that you can use the same lenders and do it again and again and again?
I mean, the ultimate success is having someone say, I want to do it again right after they're done. I mean, I think after people are used to making money off of their money and you return it back to them, then they're like, shoot, like now I'm back in the exact same place that I was before and my money's making no money. So we try to roll people into the next loan as quickly as possible. But there are some people, depending on, I mean, we usually find this out in the beginning before we partner with somebody, but sometimes they'll say like, I want to lend money so I can understand the process, but my ultimate goal is to become a real estate investor myself. Sometimes that happens, sometimes it doesn't. Sometimes they just like being passive and that's okay. I think what's also very helpful, like now that I'm getting a little bit more into syndications, a little bit longer time frames, we're able to take people who have invested in previous deals and I've built that relationship lending, you know, 1 or 2 or 3 deals for 9 months at a time and say, hey, we've kind of built that relationship. You've seen that we've performed. Do you now want to put your money into something that might be 5 years instead of 9 months? And they're kind of more likely to say yes because they've done it with us.
Yeah, it's 100%. It's almost like your risk level on a relationship has gone down. So then they're willing to give you more rope, basically.
It's a relationship. I mean, I can get it. Like if people, I mean, I'm off of the internet. So a lot of people, when I talk to them, they're like, oh, you're real. That's
Yeah.
so cool. And so it's like, if I ask them to wire me money for 5 years and we just talked on the phone the first time, I think even I would be like, I don't know what I'm going to be doing in 5 years. Like maybe I want that money. But after doing a deal with someone for 2 years, like you recycle that money again and again. I think people also get a little bit tired of having to find a new deal, then having some downside. Money's not invested for a couple weeks and that's annoying. And so they're like, okay, you know what? Like, I just want to keep the money in for 5 years and I'm okay.
I had the exact same situation. I was doing flips a lot in 2003 to 2007. That was kind of my growth period. And I kept on paying the lenders off. And at first they're like, that's great. I got my money back. But after like the fourth or fifth time, they're like, Chad, like, is there some way you can just like leave this money somewhere? Like, let's just keep it there. And I said, that's a good idea. Let me think about that. But then it was like the Great Recession, everything started changing. And sort of my business model shifted to being more of a flip business to more of a buy and hold business. And so I went back to my small group of private lenders and said, well, you know, like the name of the game now for us is buy and hold. We want to rent properties. And if I'll be willing to just pay you every single month. You'll never have a gap in your interest, but instead of paying you 10%, I need to pay you 6%. And instead of paying you off in 12 months, I need to pay you off in, at first it was like 10 years, but then I got up to 15 years on those loans. And that So it didn't,
Wow.
yeah, it didn't happen
That's
overnight. I mean,
awesome.
you had to have a relationship, but they off the street, they would have never loaned me 6% interest for 15 years with a interest only payment or a 30-year amortization. But after 4 or 5 times paying them off, you have credibility. You literally have money in the bank with them. And so I agree 100% with you that like once you build that relationship is gold. Like you might think that the deal you made money on, the flip that made 20, 30,000 bucks was where you made the money. But the real asset is that relationship with someone who wants to loan you money, because then that could be used over and over and over again. And it's beneficial to them. It's beneficial to you. This morning, I talked to my original private lender, just having a conversation with them and just chatting with them 21 years later. So it's a big deal. Like these things can last a long time and have a really good relationship.
I'm not a huge flipper. I never want to own like a flipping business. I wouldn't say it's like my passion, but I will say it's been extraordinarily beneficial for developing relationships. If you only have 5-year plays and you only have 5-year things to have people invest in, it's like, I just think it's hard to get people to wire in money for 5 years if there isn't any sort of smaller project to test the relationship on. And so I think we'll always be doing smaller projects because we have the team and because it's like now it's relatively systematized, but also for the sake of just building the private lender relationship.
I think we've given a really good overview of kind of your business model, how you started, how it worked. Is there anything else you would wrap up to give people feedback on private loans, how it's worked for you, any mistakes you've made, just anything else you think they should know if they want to go out and start doing this in their own rental property or real estate business?
Yeah, get an attorney to help you. I know a lot of people want to pull forms off of LegalZoom to save $500, but like this is people's hard-earned money, and like you got to take that really seriously. I've heard way too many horror stories of people who just like didn't know what documents. Like there was somebody who forgot to file a mortgage on title, but they just didn't know that they were supposed to ask for a title to do that. The deal didn't work out, and then the lender didn't get their money back because there was no official mortgage on title. And it was, I don't know if it was an honest mistake or not. That's on that person for not knowing and not educating a lender who wasn't sophisticated enough to ask the right questions. And so an attorney and the right title company should be able to help walk you through the process and get you the right documents that say the right things for the right state that you're in, because there's different precedent in every different state. And so like I have an Ohio lawyer, I have a Georgia lawyer, and they work on properties in those 2 states only. And so if you can find yourself someone locally to kind of walk you through the transaction and get really educated on the whole transaction in general, because a lot of times you're kind of shepherding people through the transaction and you got to be the person to be able to guide them in the right direction.
Yeah, that's great advice. And also, we talked about trust and confidence, I guess, early on too. Like if you have a team behind you, especially an attorney who knows the Ohio real estate laws and lending laws, you can borrow confidence from that person. If they're competent, then you don't have to do it all yourself. Like sometimes I feel like we have the weight of the world on our shoulders. Like, oh, I don't know how to do any of this stuff. Well, you're the captain of the ship. You don't have to know how to do everything. Like you have to know how to hire a really good attorney who can give you advice. And you're the business owner who then tells the attorney, here's what my business deal should look like. Please translate that into a legal document. Like that's a thing. People do that every day.
And also like your attorney can also talk to your private lenders. I offer that to my private lenders if they want someone to kind of walk them through. I'm happy to kind of lend my lawyer. And a lot of times I say, no, that's okay. But it's more so the sentiment that they appreciate. I also say, feel free to get your own lawyer if you want to look at your own lawyer. Like that's okay too. But it's just, I think having an attorney, if you don't know any question, it's always really helpful to say like, you know what, I don't know, but I'm going to ask my attorney and I'm going to get back to you. Like that sounds much better than I'm not sure. I'm going to go Google that and get back to you. There's just a lot more weight to it.
And you mentioned being informal with people's money. Like I talked about my grandmother, you talked about a family member. My motto, it sounds like it was with you too, is like, even with someone you know, especially with someone you know, treat them like very formally. Like it should be exactly like you would with a bank. I always tell people like, we're going to do the exact same thing we would with a bank loan. There's an attorney, there's a title company. The money goes to the title company. Please do not send the money to me. It goes directly there. Like that paper trail and the transaction, have the insurance, like that. You can't like cut corners, especially save a few $100. Like that's the stupidest thing. It seems smart in the short run, but it's like so short-sighted when you screw something up and something bad happens down the road.
Yeah, worst case scenario, you want to have a lawyer who drew up those papers.
Congratulations on what you've done with your business. I know there's a lot more I could ask you about. I've had a few questions that came in though. I wanted to shout out to a couple people. One of those came from one of our members of my community, RPM, Rental Property Mastery, Nico Garcia. And he asked to explain maybe how you've been using private money money partners as opposed to private money lenders? And maybe I alluded to that a little bit earlier on, but how do you see the distinction between, like you mentioned, you've had some partners as well. Like when does a relationship with someone evolve from a private lender or a partner, or maybe just a totally different type of relationship between those two different types of people?
Yeah, I actually call my private lenders private money partners to make them feel better. So I can kind of talk about the distinction. Like, I think a lot of people, when they're messaging you, the first thing they're going to ask you is like, can I partner with you? Because it's the only thing that they know how to ask for. And that's when you gear the conversation to, hey, I'm not looking for any active partners, but I am looking for passive partners. And that's where like the education comes in about what private lending is. I think the person's probably asking maybe more so about like partnerships in general, equity partners versus private money lenders. And I think like I really try to not have very many equity partners. I know some people who have like 20 equity partners. And I'm like, I don't know how you handle all of those LLCs and all of the weekly meetings and like this and that. And so I'm very, very selective with the equity partners I work with. And I look at it from like almost like a marriage perspective. Like, can we do this for the next 5 to 10 years together? And do your skills complement my skills? My partnerships in the past have been like, I have a partner who handles acquisitions. I don't love cold calling. Like, I don't love scraping data. Honestly, don't love putting in offers. And so why don't I have a partner who just loves to do that? And then I like on the renovation side, I used to handle all of the contractors, all of the renovations. While I can do that, I don't love to do that. And so why don't just have someone who's like, that's their passion to do that and let them do that part of it. So I can come in and do the marketing, the branding, the raising private capital, the investor relations, the things that I'm best at. So I see equity partners as a way to put people in the seats that they're best at. In the beginning, you're probably doing everything and you're noticing what you don't like and what you like. And that's kind of where you're like, okay, I can raise money and I like doing that and I'm good at it. Or can I find other people who are good at acquisitions and good at renovations and they can come into the fold and we can get a lot more specific with what we do. And then we bring in private lenders to fund our deals, but they're not equity
So it
partners.
sounds like that metaphor of having the right seats is one of the keys. Like the private money lender, their seat on the bus is to be the money person. So they've got their role. They're not going to be finding deals. They're not going to be managing them. And then within these equity partnerships, which you've also been successful with, you're identifying the different roles, finding deals, raising the money, managing the remodel, managing the property or the sales. And then you identify, do I need to do all those seats myself? Or in your case, you specialize a little bit more. And so you put a team of 2 or 3 partners together to then team up. But you all knew your roles. So it wasn't like you're stepping on each other's toes and you all said, all right, ready, let's do this. I've got this, you've got that. And then that made it clear, I guess, to make sure everybody could kind of work together well.
You just got to be a lot more careful with who you get into partnerships with because you're really in it for the long haul. And you have to really trust that people are going to handle their seat well. You can be hands off and like you're going to get the job done and I trust you. And so it's a lot more of a vetting process. It's also really recognizing what you bring to the table. I think a lot of people are just like, I want a partner. And it's like, well, why would someone want to partner with you? No offense. What can you bring? Do you have market knowledge? Like, and a lot of people say, I don't have any time. I don't have any money. I don't have enough experience. And so I kind of want to have a partner. You need to figure out what you bring to the table or learn a skill before you identify what you need specifically.
That's such good advice. And I know there's a lot of people out there who maybe they heard that and they're like, all right, that's me, like guilty. So we've all been there. Like we've all been in that beginner situation and maybe you don't have the time, you don't have the money. Like, is this hopeless? Or like, would you give advice? What skill could somebody who is brand new, who doesn't have all the experience, how could they get their foot in the door in those first deal or two where they could add value to someone? Because you had to do that. I had to do the same thing. Like, what do you have any advice for that person?
Yeah, I mean, from the time perspective, I would say make time. There is time. You need to make time. So instead of watching TV for 2 hours, learn a new skill. Maybe one of the more valuable things you can do for someone is find them deals, like really good deals, source some deals. Like a lot of people just don't have time to scour Zillow to make relationships with agents, to analyze a bunch of deals. But if you're consistently being like, oh, I got great deals, there are a lot of people who have a lot of money who just don't have any great deals because they don't have any time. And so if you can kind of come to the table with a deal, it's easier to find someone who can fund it.
Well, thank you for your transparency, Soli. You're really an inspiration to a lot of people and appreciate you sharing your details of your business today. And I know people are going to want to hang out with you and follow you after they listen to this. So maybe I want to give you a chance to tell people what you have going on and where they can follow up with you.
Yeah, Instagram's the best place. It's just lattes and laces.
Soli has a great Instagram channel, and she's sharing other stuff you have going on, like your new boutique hotel that you're working on at the moment as we're doing this interview. So check her out, and she's got lots of great products and freebies and some paid stuff as well. So check it out. I'll put a link in the podcast and YouTube description below. So thank you again, and look forward to connecting with you again soon. This episode was all about finding and using private money for your real estate deals. But one thing we didn't talk about was, how do you actually make deals cash flow? How do you make the numbers work, the analysis work when you're borrowing private money or even borrowing regular mortgages at higher interest rates like 8%? So my next video is all about how do you make deals cash flow in today's market at higher interest rates. I go through examples and case studies. I pull out the whiteboard and explain it to you in detail. So check out that video. There'll be a link to it above me here if you're watching on YouTube, and there'll be a link in the video in the podcast description below.